Did you know that tax code changes can collectively reshape the financial landscape of an entire nation? In the United States alone, these small shifts can influence trillions of dollars, impacting businesses, families, and individuals. Every decimal point counts if they serve to sway economic tides. What does this mean in essence? Staying updated on these changes isn't a matter of choice. It's a financial survival skill. Your earnings, deductions, and credits hang in the balance. We will take a look today at some tax changes in 2023-2024. So, what are the key changes in the 2023 tax code? Long-term capital gain tax rates is one of the key ones. In 2023, the tax rates for long-term capital gains and qualified dividends remain unchanged. However, the income limit determining these rates were adjusted to account for inflation. For the 0% rate, individual taxpayers with taxable incomes up to $44,625 on the single returns and $59,750 for head of household filers and $89,250 for joint return qualifiers. These thresholds were $41,675, $55,800, and $83,350 in 2022, respectively. So quite a little jump there. The 20% rate for 2023 applies to individuals with taxable incomes starting at $492,301 for singles, $523,051 for head of households, and $553,851 for couples filing jointly. In 2022, these thresholds were $459,751, $488,501, and $517,201, respectively. If your taxable income falls between the 0% and 20% breakpoint, you'll be subject to the 15% rate. The 3.8% surcharge tax on net investment incomes remains unchanged for 2023, impacting single individuals with modified adjusted gross income over $200,000 and joint filers with modified AGIs over $250,000. Standard deduction. The standard deduction amounts for 2023 has been raised to adjust for inflation. For married couples filing jointly, the standard deduction is $27,700, with additional $1,500 for each spouse age 65 or older. Singles are eligible for a standard deduction of $13,850 or $15,700 if they're at least 65 years old. Head of household filers can claim a standard deduction of $20,800 with an extra $18,050 once they reach the age of 65. Additionally, those individuals who are blind can increase the standard deduction by $1,500 or $1,850 if they're unmarried and not a surviving spouse. These red figures represent a little bit of an increase from the 22 standard deduction amounts. Next one I'm going to talk about, a little bit out there, but it's real, guys. It's a real thing. Service and emotional support animal tax deduction. That's right. Yes, deductions for pet expenses is a thing, but it's a special way to qualify for it. So people can deduct medical expenses paid during the tax year that exceeds 7.5% of their adjusted gross income in 2023 using Schedule A of Form 1040. That means that your pet helps you in a medical capacity or performs certain services. You may be able to claim them as a qualifying medical expenses. For example, individuals who are disabled who rely on a service animal for assistance may be able to claim a dog as a qualifying medical expense. Dogs that perform specific services such as guiding a blind person, alerting a deaf person, assisting with mobility with ambulance, or protecting an epileptic person during a seizure may be eligible for this deduction. But it doesn't just end here. In some cases, you may be able to claim emotional support animal tax deduction, but it's important to note that not all pet qualifies as an emotional support animal with therapy dog. Qualify for a pet tax benefit, your animal must meet the criteria of being an officially recognized ESA, or emotional support animal. It's crucial that your pet plays a significant role in providing essential service or functions in a medical capacity. To substantiate this, you'll need proper documentation from a healthcare professional confirming the animal assists with a diagnosed mental or physical condition. This documentation is also essential in demonstrating your genuine need for emotional support animal and plays a pivotal role in designating your ESA as an eligible medical expense. Residential clean energy credit is the next one that we want to talk about. If you incorporated an alternative energy system at your residence, ones that use renewable sources like solar, wind, geothermal, or fuel cell technology, then you qualify for this credit. The credit covers a range of equipment, including solar panels, solar electric devices, solar power water heaters, and wind turbine. Notably, starting in 2023, the credit extends to battery storage technology with a minimum capacity of 3 kilometers an hour. The credit amount is set at 30% of the total cost of equipment and installation for renewable energy systems. This full credit will be available until 2032, at which point it decreased 26%, 2033, 22% to 2034, and OS rate expires in 2035. Before we proceed, quickly do me a favor. Can you hit that like and subscribe button up there? This is so that you not miss out on future updates on tax savings. Done? Alright, let's see what's in stock for us next. Home Improvement Credit. The tax credit for enhancing your home's energy efficiency, such as due to the installation of windows, doors, and more, has undergone a complete transformation starting this year. In 2022, it covered 10% of the expenses related to specific insulation types, external windows, doors, skylights, electric heat pumps, water heater, central air system, and similar energy-saving updates. There was a lifetime credit cap of $500, and various items had the credits cap. Now, for the year 2023 to 2032, this credit gets a substantial upgrade. Firstly, the credit percentage rises in 30% of the expenses for specific installation, boilers, air conditioning systems, window, doors, and other additions to your home. Secondly, the $500 lifetime limit is replaced by an annual limit of $1,200, which is adjusted to $500 for exterior doors and $600 for exterior windows, skylights, and other items. The annual limit increased to $2,000 for biomass stove, hot water boiler, or an electric or natural gas heat pump installed in your home. Third, you can also receive a credit of up to $150 for the cost of a home energy audit. Even though in the tax code fund, well, it can save you a lot of money. Next, let's talk about retirement savings changes. As some positive news for retirees, the age at which you must start taking required minimum distribution, or RMDs, has increased from 72 to 73. For traditional IRAs, 401ks, and other workplace retirement plan owners, these all qualify under this change. This change applies to individuals who reach the age of 72 after 2022. If you turn 73 this year, your first RMD is due by April 1st, 2024. Those who continue working past the age of 73 can usually delay RMDs with their current employer's 401k until retirement. Penalties for failing to seek RMDs have been reduced. Starting in 2023, the excess tax for such non-compliance is 25% of the missed RMD amount, down from the previous 50%. The penalty for timely correction has also been reduced to 10%. For those still saving retirement, various dollar limits on retirement plans IRAs have increased in 2023. For instance, the maximum contribution limit for 401ks, 403bs, and 457 plans have risen from $20,500 to $22,500 for 2023. Individuals born before 1974 contribute additional $7,500 as a catch-up contribution, which is up from $6,500 in 2022. This means that someone aged 50 or older in 2023 can contribute up to $30,000 pre-tax to 401k, 403b, or 457. The 2023 contribution cap for the simple IRAs is $15,500, up from $14,000 in 2022, with additional $3,500 available for individuals aged 50 and above, up from just $3,000 in 2022. The 2023 contribution limit for both traditional IRAs and Roth IRAs have been raised to $6,500, with additional $1,000 catch-up contribution available to individuals aged 50 or older. In 2023, contribution phase-out when specific adjustments, gross income ranges, have also been adjusted and increased. The $218,000 to $228,000 for couples, and $138,000 to $150,000 for singles. These ranges have increased from $204,000 to $214,000 and $129,000 to $144,000 respectively in 2022. Deduction phaseouts for traditional IRAs now begin at higher AGI levels in 2023, ranging from $116,000 to $136,000 for couples and $73,000 to $83,000 for single filers. These figures represent an increase from the 2022 threshold of $109,000 to $129,000 for couples and $68,000 to $78,000 for single filers. When only one spouse is covered by a retirement plan, the phase-out range for deducting contribution for the uncovered spouse starts on an AGI of $218,000 and ends at $228,000, which is up from the limit in 2022, which is $204,000 to $214,000. The next topic of change we want to talk about are saving accounts. In 2023, the maximum deductible contribution to a health saving account, or HSA, have increased. For self-only coverage, the limit has risen from $3,650 to $3,850. For family coverage, has increased from $7,300 to $7,750. Those born before 1969 contribute an additional $1,000, the same as 2022. To qualify, insurance policies must restrict out-of-pocket costs to $15,000 for family health plans compared to $14,100 in 2022, and $7,500 for individuals with coverage compared to $7,050 in 2022. Minimum policy deductible has also gone up, with a minimum of $3,000 for family coverage and $1,500 for individual coverage compared to $2,800 and $1,400 in 2022, respectively. What steps can individuals take to adopt to the new tax code? Try to stay informed and abreast of the new tax code changes. Listen to the videos like this where I'll always provide updates for you guys and how it impacts your specific financial situation. And also review your assets and investments. Consider adjusting your investment portfolios in light of changing tax rates on capital gains and dividends. Which strategies can business investors use to adapt? Business restructuring, definitely one. Adapt your business structure to align with the changing tax landscape, and also explore opportunities for tax savings. Check for credit too. Identify and leverage tax credits available to businesses, such as those for renewable energy for research and development. So, what are the roles of tax professionals in all of this? Number one is definitely on the expert guidance side. Tax professional plays a pivotal role in helping individuals and businesses navigate complex tax code changes. Strategic planning. They provide tailored strategies to maximize your tax benefits and reduce liabilities. Overall, they just give you more time back to focus on being the CEO of your business and less on the compliance side. Leave that to the experts so you can focus on taking your business to the moon. I hope you enjoy watching this video and would like to see similar videos in the future. Best way to always stay updated is subscribe to my channel and smash that thumb up button. Thank you for supporting Free Cash Flow Agency. Thank you for supporting my content. If you want to leave any comments, tax questions, bookkeeping questions, consulting questions, feel free to leave it below. I'd love to get back to you and provide that valuable insight advice for you. Thanks again so much. Hope you had a great holiday season. Hell out.